Thank you for joining me. It is Wednesday, July the 12th, 2017. I'm Gord Long. A reminder before we begin, do not trade from any of these slides. They are commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. The purpose of the audio slides is to talk about the areas that are not updated in your monthly analytics and technical analysis report. This is based on our annual cycle as outlined on the subscriptions page on our site. We intentionally keep the technical analysis charts to the subscriber reports so as not to confuse them with the drivers operating behind them. Drivers in the long term are primarily the fundamentals. In the intermediate term, risk. And in the short term, confidence and sentiment. This month I'd like to cover some observations I have regarding how the public narrative in the media is hiding and in fact obfuscating the reality of what is actually happening within the U.S. economy. I'd like to cover the following subjects shown here. So, what are the professionals saying versus the media and the public narrative? Paul Craig Roberts, a former Assistant Treasury Secretary under the Reagan administration and a former Wall Street Journal editor, news editor, who I've interviewed on a number of occasions over the years, recently released a short article entitled "Ever More Official Lies from the U.S. Government." He starts it off by observing, and I quote, "The false reality constructed for Americans parallels perfectly the false reality constructed by Big Brother in George Orwell's dystopian novel 1984. I also covered this personally in prior thesis papers on how I felt this was occurring. To continue with his quote, "Domestically, Americans are assured that thanks to the Federal Reserve's policy of quantitative easing, that is, flooding the financial markets with newly printed money, that has driven up the prices of stocks and bonds, America has enjoyed an economic recovery since June of 2009, which must be one of the longest recoveries in history, despite the absence of growth in median real family incomes, despite the growth in real retail sales, despite falling labor force participation rate, despite the lack of high value-added, high productivity, high-wage jobs. The recovery is more than a mystery. It is a miracle. It exists only on fake newspapers," and that's according to Paul Craig Roberts. He goes on to factually prove his point. We don't have time to go through his points here, but I encourage you to read his article. What is important to investors is whether the economic news and its controlled narrative actually reflects reality, expected returns, and the degree of risk to achieve those returns. Therefore, I thought I would share with you some of what I personally look at to determine the real U.S. investment reality. Because of space in this missive, I will leave the global landscape for simply another day. And of course, we've talked about that fairly extensively in prior videos. I'd like to delve into the details, first of all, of discretionary spending and consider subjects such as the vices. Vices normally lead overall retail sales. It is presently reflecting a very rapid decline, which suggests we should expect overall retail sales to follow very soon, and I think we're already beginning to see weakness in some sectors of the retail economy, retail apparel specifically. Consider gambling. Gambling continues to slow and is now actually contracting, as reflected by the average rates of gambling growth decline in Detroit, Maryland, Connecticut, Atlantic City, and Pennsylvania. While comps play a role in exaggerating some of the contraction, the trend is clear. There's less gambling. This normally means less hot money floating around households to play with. I also like to consider off-the-grid items like prostitution and escort service prices, which I have to thank the Moneyballeconomics.com, which actually researches and tracks this. I don't know how they do their research, but they do the research on it. What they have found is that prostitution and escort service price inflation is slowing. A sampling of escort prices in major urban markets shows that after moving up sharply in late 2016 and early 2017, price hikes have leveled off recently. The reasons are: 1. Market dynamics. The recent big 15% on average uptick in prices has to be absorbed. 2. No inflation pressures. Hotels are the primary costs that escorts pass along, and hotel prices are flat and even down in most major areas, at least per Trivago's Hotel Pricing Index. 3. Opportunity has slowed. Price hikes have been largely opportunistic. That is, thanks to the surging stock market beginning in fourth quarter 2016, customers seem to have extra disposable income. The S&P surged approximately 15% in the 4 months from November to February, but only 1.5% in the 2 months since then. Even more interesting is that apparently mid-tier escorts have begun to offer discounts. The frequency is limited, but enough to stand out, and the price deflation is significant. It rolls back most of the recent price hikes. Why the soft demand? It's affordability. It's not that pay-to-play inflation outpaced affordability. Prices were raised approximately 9 months and demand remained strong. Suddenly the phones weren't ringing off the hook, and it's not stiffening competition. This is a demand problem, and price cuts are a great way to firm up demand. If this is the trend, we'll see more discounting through the summer. I also like to look at restaurants in this context. The last time this happened, it was the pre-warning to the financial crisis. Usually, however, it is normally a reliable sign of an approaching reversal in the business cycle and the likely coming of a recession. The National Restaurant Performance Index is suggesting that restaurant industry growth is not only slowing, but now actually bordering on a possible contraction. We are seeing that restaurants in general are unable to pass on employee wage increases due to the increases in the minimum wage. They are being forced to cut labor and automate using kiosks and other forms of exploding and rapidly emerging robotic applications. I, like other economists, like to look at sales of discretionary goods to determine whether or not the consumer is experiencing any potential weakness. Motorcycles tend to be a closely watched discretionary barometer and is a favorite of mine. For the last 3 quarters, Harley-Davidson's management, that's the symbol HOG, as reported by Bloomberg, has said that, and I quote, "The industry is struggling amid soft used bike prices, economic uncertainty, and the weakness in oil-dependent areas." This looks like a top, especially when you consider the attendance at the spring rallies at Americade in upstate New York and Laconia in New Hampshire. Attendance was way down yet again. A relative who attended these rallies for 20 years told me he was staying in hotels downtown when in prior years he had to find accommodations anywhere from 20 to 30 miles away. In fact, he stopped in to see me this year for only the second time in 20 years. He said I would likely offer somewhat better entertainment value than the failing rallies. That should tell you all you need to know about how bad it must be. I'm not an entertainer by any stretch of the imagination. I also like to examine overall business activity from the perspective of gasoline sales and energy usage. Gasoline inventories are now at the highest level in 5 years as average prices at the pump have fallen nationally. It's a demand problem, not just oversupply. Bank of America Merrill Lynch was stunned by the drop in gasoline demand and penned a report on, and it was called, "Where is the Driving Season?" Consider power and energy consumption. The June release from the U.S. Energy Information Administration, and by the way, I don't think anybody seems to follow it, shows that total U.S. energy usage has been in decline since the financial crisis, and in the last 3 years has been basically flat. This shouldn't occur this deep in an economic recovery at all. This goes contrary to everything that we basically understand in economics. Clearly, there's something else that's been going on for a sustained period of time. Consider rail and intermodal shipping. AAR, that is the Association of American Railroads, their senior vice president, John Gray, stated recently, and I quote, "Rail traffic indicators of the economy remain mixed, while some commodity groups such as intermodal, chemicals, and crushed stone and sand, driven heavily by fractionating sand, set new all-time first-half records, and a few others like grain and coke set post-recession records. Several other traffic categories continue to struggle," which is just about all the remaining ones. Most of this gets little to no coverage. It may be meaningless to the media narrative, but it has sheltered me many times from missing the major shifts in the economy. I also like to examine what I will call complacency. That is the degree of greed versus fear. The VIX is a good place to start here, though it is now becoming quite highly manipulated in my opinion. The markets have become incredibly complacent, yet the financial media fails to point this out. It tells us that the VIX is low, which means the markets see little risk. It also tells us that earnings will continue to improve. What it fails to tell you that overly optimistic outlooks coupled with little fear over a long period of time is a precursor for a disaster. The way to consider this is the forward PE to VIX ratio. Peaks here are quite problematic, especially when earnings have been as a result of cheap money and the central banks are being very clear that quantitative easing will soon become quantitative tightening. More on that here in a moment. Greed is often most telling in the level of valuations against historical norms. I have spelled out on many prior occasions the degree of overvaluation by almost all measurements that we're currently experiencing. Again, the media fails to really dwell on this and certainly to warn us of it. It only occasionally mentions this in passing so as not to worry investors and displease advertisers. Additionally, and most importantly, is to examine whether the major underpinnings of the market have changed. Sometimes they change and you don't really spot them, or in fact realize that was what the whole market was based on, or the recent period of trend rise. One old market adage is don't fight the Fed. It is equivalent to swimming upstream against a very strong current. You may last for a period of time, but eventually it completely wears you down and washes you away. We've had a major shift in Fed central bank policy, at least their direction and their outlook, and this is what the whole market rally has been based upon. The Federal Reserve, the Bank of Japan, and the ECB have all sent clear directional communications on their intent to shift from quantitative easing to quantitative tightening in late 2017 and 2018. These are seminal announcements. Unless you have been living in outer Mongolia, you are fully aware that the financial markets have been a happy prisoner of the captive central banks and their unrelenting liquidity pumping. Without it, there can be little doubt that at some point, and I repeat, at some point, the markets are going to abruptly and violently react to this. Knowing this should be enough. However, when greed has hold of the markets, or performance bonuses may be a better way of saying it, then scalping every last tick appears important. To me, it is no more than picking up dimes in front of a steamroller. The risk return simply doesn't merit it. The media, however, doesn't relay this nor point it out. It's not part of their narrative. They actually don't see that to be their responsibility, and their corporate lawyers advise them not to. They report markets are rising and talk about positive things. No one gets sued for that. Talk about negative things, and they have found they get sued and blamed for the possible market falling. The media learned this painfully during the dot-com bubble collapse, when public securities litigation and greenmail became a cottage industry for every lawyer in America. That is one of the reasons why market corrections always come as an apparent surprise to retail investors, even though all the signals were readily apparent. It is my personal opinion that the central banks are trying to gingerly tap on the brakes because they see speculation, leverage, and financial condition sentiment to be in the danger zone. They also know that the business cycle is historically 5 to 7 years from recovery to peak. The maximum it has been in modern era is 10 years. We are currently in the 8th year. However, like tapping your brakes on an icy road, you can quickly and suddenly find yourself in a spin and completely out of control. There are many Cassandras out there warning of the damage that central banks are going to do with their shift in policy direction. Here are just some of the headline titles which are buried in the financial media coverage. You don't often hear Jamie Dimon at JP Morgan warning that QE unwind could be far worse than the Fed hopes. He usually takes a much lower profile on a subject like that. We have Morgan Stanley talking about who moved my punch bowl, and that is we're going to see a repricing of the central bank put. And they suggest it's imminent. I don't know if I quite agree with that, but that's what they're saying. Derivatives trading legend was quoted as saying, as little as a 4% decline in one day could start a critical crash, an avalanche if you would. PIMCO's chief investment officer says the firm is now reducing risk across the board. This is one of the largest, if not the largest, bond fund in the world. We have a flat yield curve and a terrible bond market reaction to the policy shift. The bond market simply doesn't believe the Fed is right. So not only is the Fed setting us up for a serious problem, additionally, it could be, in fact, wrong and have to reverse, which in itself has often been disruptive to the markets. Though a reversal and easing usually pushes the market up, but only would they do that if we've seen a fairly large correction or a worrisome correction. But with the amount of over leverage we have in the market, it could quickly become an avalanche without them having the abilities to stop it, because it would not be a U.S. problem. It would be a global problem almost instantaneously. So what and when will reality be forced upon the markets? The list of possibilities is endless. North Korea, a policy mistake or a miscue which quickly escalates out of control. A Trump dump, that is due to failure to deliver against inflated and simply unrealistic expectations. Obamacare repeal and replace is seen as nothing, could be seen as nothing more than a camouflage spending cut, which it is, to finance tax reductions. And the infrastructure fiscal stimulus becomes bogged down because PPP, that is private-public partnerships, which the Republican Party wants to use, only barely works for high-return projects like toll roads, airport parking garages, toll bridges, etc. Nobody's fond of those. All the rest of them, they just don't have the payout. If tax relief comes off the board in any major fashion, we have a really major problem. And that's almost to be expected, because right now federal, state, and city tax revenues are falling like a rock. We could have a terrorist attack, a desperate ISIS, which has just recently got crushed in Mosul, begins to escalate its attacks and takes it to another level of destruction, like smart bombs, chemical attacks, or a brutal, highly visible suicide attacks on global leaders, and who knows what else. Cyber attacks, where we could see ransomware become a new widespread and destructive terrorist tool to finance itself and wreak widespread disruption within the Western financial system. If history is any indicator, you can be assured, whatever it will turn out to be, it will come as a complete shock and a surprise. The famed short seller, Jim Chanos of Kinnikos Associates, recently stated when asked, "How serious do you view the weakness in the economy?" And his answer was, and I quote, "One of these things that we've talked about wouldn't be bad, but you put them all together and the U.S. economy doesn't look so great." The big three drivers are still housing, autos, and the healthcare. They are disproportionately counting for a huge amount of activity. What we see is that housing has stalled, autos have turned down, and healthcare is possibly about to turn down. Retail is also turning down. Nike is laying off 2% of its workforce. I can't remember the last time Nike said it was laying off people. And again, I'm quoting him here. Again, this could simply be cyclical, and as we reach the end of the expansion, it gets harder and harder to generate new sales as people's leverage has gone up. It could be that, but the problem is that we're not well equipped to handle anything other than a downturn that's mild, because the Fed is already at near zero interest rates. Interestingly, the deficit is starting to go back up because of lower tax receipts. He's also noticed the same thing as I have. That's the wrong way for the deficit to go up. New spending, like government spending on infrastructure, would be the right way. And as I just mentioned here earlier, that has a serious hook in here that the Democrats will never sign off on. I thought he summarized it pretty well. It isn't even close to what the media portrays. Advertisers and owners don't want that sort of message potentially impacting customer confidence, investment, and/or consumption. Every time this chart here has occurred, bad things have subsequently happened. But you will never find this in the public news narrative when it is pretty darn clear what is going on. As I often do, remember, They will print the money to solve any and all problems until such time as no one will take the money or it is of no value. That day is still in the future. So take advantage of opportunities as they currently exist. Investing is always easier when you know with relative certainty how the powers to be will react. Your chances of success go up dramatically. I would like to take a moment as a reminder, do not trade from any of these slides. They are for educational and discussion purposes only. Thank you for listening, and until next month, may 2017 be an outstanding investment for you and your family. Thank you for listening.